Good morning, investors. So, latest Q1 FY26 GDP numbers are out, and in today's episode, we will be discussing how good are actually those numbers and how those numbers are going to affect market going forward, and why, despite of such good numbers, I still prefer to maintain bearish view on the market. So, today is 1st September 2025, and let's start. So, first of all, I guess you might be aware that in this quarter, India has reported 7.8% growth in GDP. For the same quarter in Q1 FY25, the number was 6.5%. So, in order to first analyze how good is 7.8%, we should be aware of the components of GDP. Now, GDP is basically made up of 5 components, and for each component, I have plotted growth rate, the growth rate which is in current quarter, and the growth rate which was reported for the same quarter in past FY25. Firstly, we have your private consumption. Private consumption means the normal consumption or the normal expenditure which is done by the consumer. For example, say you buy clothes, you eat at restaurant, or you buy television, you buy phones. That all is covered under private consumption. Next comes government expenditure. These are the expenses which are done by the government for running the country. For example, government salaries, pensions, and also your freebies, your subsidies, all are covered under government expenditure. Next comes gross fixed capital formation, which is also known as investments. For example, if government build bridges, roads, or even if some private companies are setting up or doing some capex, or if you buy some house or real estates, so that all covered under investments. Next comes our exports, and then we add these and minus import from this figure, then we get the GDP. Now from the growth rate data, you can see that the major contribution in 7.8% number is being done by government expenditure and your gross fixed capital formation, that is also investments. And on the other hand, your private consumption, that is what urban or the rural consumer is spending, that has been decreased. Earlier it was 8.3% and now it is 7%. That means your main GDP growth is being derived by your subsidies, your what I can say, your freebies, your capital formations. This means if we look at a micro level, that is on a person to person, consumer is not able to spend money. Either his income is not increasing or there are some other factors, but your GDP is growing only and only due to government expenditure and the investment which is being done by the government and the private companies. And honestly speaking, for long run, in order to maintain the pace of such growth, private consumption has to grow. Again speaking, government may continue to give freebies or your subsidies or keep on building your road, bridges, but it is not a long-term solution. In order to match or in order to grow at this pace, private consumption has to grow. And honestly speaking, the situation of consumer as per this data is not looking good. Let me take another example. You can see investments. You can see there is a growth of 7.8% earlier as compared to 6.7%. Now, if you buy house or real estate, that will be the part of your gross fixed capital formation, that is investment. Now, if I look at the housing data, here it is. The main growth even in the housing sector is coming from the high-end luxury or the ultra luxury segment, whereas the affordable or mid segment is not able to increase their share in your real estate sector. Now what does that mean? That means your GDP is increasing, your numbers are looking good, but if we go at a micro level, on a person to person level, then person income is not increasing. That's why he's not able to spend more. And honestly telling, private consumption forms 60% of your GDP. Rest other factors contribute 40% GDP. In short run, government expenditure, gross fixed capital formation, investment can push GDP number, but in long run, private consumption has to grow. Otherwise, this number will not be able to sustain. Now you will say, hey Arpan, let's not dissect the number. Overall number looks good. So how is it going to impact the markets? And let me tell you, from the overall market perspective, this number is not that good, and let me explain why. Now, to understand that, you have to look from the perspective of FIIs, and for them this number of GDP 7.8% is completely irrelevant, useless. For them it is of no use. and I will explain you why. See, FIIs, they invest in your stocks, and what is the main factor that drives stock prices? That is corporate earnings. Corporate earnings. They are not concerned whether your GDP is growing at 7.8%, 10%. They are concerned at which rate corporate earnings are growing. Generally, corporate earnings grow 1.5 to 2 times of your GDP growth. So, by this logic, your corporate earnings should grow by at least 10 to 15%. Now, is that happening really? Now, if you look at the Nifty 50 Q1 FY26 earnings, it was somewhere around 7.5 to 8%. However, there were some exceptions like LT, which has reported 30% growth, but the weighted average comes out to 7.5 to 8%. Now, as per GDP, we expect our corporates to grow at 10 to 15%, but they are failing to meet that expectation. They are growing at 7.5 to 8%. Now, we all know how this growth is coming. We have dissected this growth in the earlier part of the video, so you are able to understand that why FIs may not be happy with this number, because this number is basically driven by the your government spending and the investment that is done by the rich or the ultra rich class. Your nifty IT companies, FMCG companies, they are not able to grow or able to match this pace. Apart from this, now look at again from the FIS perspective. Currently Nifty 50 PE ratio is somewhere around 21. We use a metric called PEG ratio. That means we divide PE ratio by growth. So if I divide 21 by 7.5, I will get somewhere around 3. Any number above 1 is an overvalued opportunity. That means if Nifty PE is 21, then company should report at least 21% growth to meet the expectation of institutions. So although your Q1 FY26 GDP data looks very good, but that does not correlate with your corporate earnings data. Now for FIIs, their capital is very mobile. That means they are not restricted to invest only in India. They have other options as well. And the problem with us right now is that other emerging and Asian markets are very cheap compared to India. If you look at the PE ratios of South Korea, China, Taiwan, they are in between 10 to 20, and if you look at their indices, they are almost all-time high. See, at the end of the day, I am not a big fan of technical analysis. I don't draw any moving averages, and I think institutions also don't draw any moving average or support or resistance. Everything comes down to valuation. If valuation match earning pace, FIs will return. If valuation won't match earning pace, they will try to find any other territory where they find cheap valuations, like you can see on the screen. So despite of such strong GDP number, I still prefer to maintain bearish view because of the weak Q1 earnings of our nifty companies and continuous FI selling. Now since I am recording this video before market opening, what I think will happen is either today or in a couple of days, market might give a pullback, might start increasing on the basis of this news, but FIs will see this opportunity to dump equities on retailers. So please be cautious. Don't join the party if today market increases or if continues to increase before Q2 results. Now let's try to design a roadmap which ideally I will be following. If you want to follow, please first consult with the financial advisor whether it suits your risk profile or not. So scenario 1, if market rises, say today market rises or continue to rise this week, if market rises, I will prefer to stay away from this rise. I will keep my existing equities to grow, but I won't infuse fresh equities. So no fresh investments if market rises on this news. Next comes your scenario 2. If market ignores or gets sideways, and if we get a good correction in the upcoming week, then it will be good time to accumulate good stocks where growth guidance is very good. Now, which are those kind of stocks? First of all, I closely track power T&D sector. In power T&D, you have Hitachi, Siemens Energy India, GE Vernova T&D. In the EPC space of power transmission, you have Techno, Transrail Lighting. In the cable segment, you have KEI, Dynamic Cable. So it's a big space, power T&D. And in the upcoming videos, I will discuss it in details. Here, the guidance is very good and the numbers are very strong. Manufacturing sectors. And in the manufacturing, I am closely tracking MBEL, which is a new listing, and any other stocks where we have the high guidance of growth. For example, I am also tracking Oswald Pumps. They have a high guidance for Q2, and also we will discuss more stocks in the upcoming video. But in short stories, I will be accumulating stocks where the guidance is very strong of the management. See, at the end, what matters is valuations. If I am saying, for example, P is currently very high, then what will happen is two things will happen. Either price will come down. When price will come down, PE ratio will automatically come down, and that PE ratio will attract FIs to invest. In Q2 results, what happened is, for example, your earnings increase. So if you know the basic mathematics, that if denominator increases, that is earnings in this case, then price ratio will automatically come down, and again it will become attractive to FIs depending upon how Q2 earnings season goes. So in short, Q2 is very important, and as we discussed in case 1, if market rises, I won't buy any fresh position until Q2 earnings season starts. So if we have to summarize this video, so in the beginning we have discussed the GDP components. We have decoded why this number is not as good as it appears, and then we have discussed your how FIs might behave on these numbers, and then we have discussed a roadmap how we should go, because, and in short it is, if market continues to rise, we will stay cautious, because since valuation of Indian markets are still very expensive compared to the other Asian markets, and if market continues to fall or go in a sideways, then it is a very good time to accumulate manufacturing, power, T&D sectors, which we will be discussing in the upcoming videos. So thank you for watching today's video. I will try to keep posting videos on regular basis. So I will meet you tomorrow. Thank you.